after today's producer price index, basically the wholesale price is not what you pay, came in a little bit lower than expected. Of course, this on the heels of yesterday's elevated consumer price index. That is what you pay, that caused markets to go down. So how do we square all the different noise and data points that we're getting there in the market? Well, joining us now is Neel Mukherjee. He is the Chief Investment Officer of TIAA's Wealth Management Division. Neel, thanks for coming on. How do we square it? One up, one down, couple months hot, couple months not. What's your take?
Well, Brian, the issue is if you take the totality of the data on inflation this year, it's looking firmer than expected. So 1 month higher than expected is a blip. 2 months higher than expected is a bit of a seasonal aberration. 3 months is a trend. And so if you go back as to why this is happening, it goes back to December when the Fed pivoted in a dovish fashion. If financial conditions have eased up substantially, stocks up, credit spreads are tight, interest rates are lower, firmer growth, firmer inflation. So that's what is now seeping through into the economy, and the Fed has to be really careful here. They have to push back and appear a little bit more hawkish than they have.
You said something, you sat down, we were chatting, and you said your clients were starting to ask you about Fed rate hikes. And I said, not cuts, hikes. And you said, yes. So you got some smart clients, and they're talking about the possibility of a rate hike.
It's interesting, right? The first thing that people are worried about is, can equity prices, for example, keep progressing without any Fed rate cuts? I think the answer is yes. But you're right, there are certain clients who are now asking, does the Fed need to hike? Has the Fed done enough? I think what the Fed really needs to be aware of, and what they should be aware of and are, is what happened in the 1970s, like we talked about, Brian, because back then, inflation came back in 3 waves, all because either there was some geopolitical issue or the Fed wasn't doing enough. And the Fed knows that. This Fed needs to keep rates higher for longer, needs to make sure that inflation starts to glide lower towards their 2%. Now, I don't expect them to pivot when it gets to 2%. That would be a little irresponsible. But if it gets to 3, 2.5, that's where the structural new rate of inflation could be. They need to iterate the market, but they need to start by sounding a little bit more hawkish.
So the mission is not accomplished.
It definitely is not accomplished.
The Fed is supposed to also look at jobs, the dual mandate.
Yeah.
I would imagine they don't need to right now, that it is 100% inflation.
They do. I think what
they mention jobs, their notes and their minutes and everything, but I got to imagine that it's all inflationary talk.
I agree with that. So when they did the pivot, I think that was because they were focusing on risk management, on the growth and the labor market side of the equation. The Fed was staring down the barrel of a soft landing, and they just wanted to walk through it. And now, on the other hand, they need to pivot to focusing on risk management on the inflation side of the equation. That is the most important thing for the Fed right now.
Jay Powell's a powerful guy. The Fed's a big organization. It's got a balance sheet, by the way, bigger than the budget of the United States of America. But I don't know, as powerful as the Fed is, what they can do about auto insurance rates. What can Jay Powell do about the lack of housing availability? There's nothing they can do about the things that I think are truly inflationary.
That's absolutely right, Brian. And that's one of the reasons we think that the Fed may not be able to get to that 2% inflation, because we may be in a world which is about 2.5%, 3% like inflation levels. You look at how the global economy is these days, there's a scarcity of labor. The availability of cheap labor is not there anymore from China. There's a scarcity of commodities, especially as we transition to the new energy economy. There's a scarcity of housing. Millennials are aging into their prime age of buying, consuming, household formation. They cannot get housing to buy. And the deglobalization trend, reshoring, friendshoring, ally shoring, that leads to higher prices for everyday products. I'm not saying inflation will be stuck at 4%, but perhaps 2.5% to 3% is the new norm.
Yeah.